Lender's 20 questions on pass-throughs and K1s, video number 10, the debt shortcut. Well, the debt shortcut is handy in some cases and it's a bad idea in others. So first I'll tell you what it is, and then I'll tell you when it won't work, and finally when you shouldn't use it. Here's what it is. The debt payments for the year are interest expense plus the principal. Well, we know the interest expense from the front page, and if you've got a Schedule L and you've got mortgage notes and bonds payable in less than 1 year, you can use the end of the year figure as the principal, put those two together, and that's a pretty good guess as to debt. I promise to tell you when it wouldn't work. It won't work if the balance sheet wasn't done correctly. If they haven't taken the short-term portion of the long-term debt and moved it up into that line, mortgage notes and bonds payable less than 1 year, then you don't have the principal for 1 year. Now you might do a shortcut to the shortcut and just take the long-term numbers and take the difference between beginning and end of the year. That would be the principal pay down. Of course, that won't work if they've actually borrowed more money during the year. And the other time the debt shortcut just won't work is if they've put up in that mortgage notes and bonds payable in less than 1 year the outstanding balance on the operating line. So those are all the reasons why that shortcut might not give you the right answer. And when should you not use it anyway? Well, if you're lending to this entity, information about debt that was the end of last year or the year before is not particularly helpful. So if you're lending to this entity, you need to ask for current information. But maybe you are lending to an individual who is one of the owners, and you're more than happy to just make sure that the business is not in the hole. Maybe what they've been taking home is more than enough to qualify. You're just looking for a problem. Then the debt shortcut might be sufficient. Or maybe you're lending to another entity. The owner of that entity also is a part owner of this one. So once again, not lending to these folks, but you're really trying to be sure nothing's gone wrong. Finally, if you are, say, the relationship manager and you're just trying to see if this is even a relationship worth going after, you might use the debt shortcut in that first sort of quick and dirty analysis to see if it's worth pursuing. If you enjoy this information and you would like to receive all 20 free videos of the top questions lenders ask and should ask about business, personal, and global cash flow from pass-through entities, along with a copy of my tax return analysis quick reference guide, visit the URL on your screen.